the gold silver ratio is hovering 100 to 1, crazy. And you think we're having this gold bull market, and yet silver, it's made move positive, but not the dramatic moves where it really outperforms gold, which is confirmation of a gold bull market. And we've seen that throughout history. And we're not seeing it now. So that would make people like, has silver gotten less appealing? My answer to that is we're not in the gold bull market yet, even though we've seen these all-time highs. Silver's lagging because gold hasn't really begun its bull market rip. I really believe that. I'm not here to predict, there are people on TV or on certain shows calling $600, $700, $800 silver. I don't know, or even $5,000, $4,000. That's a mug's game again. I know at 35, 36, or 37, it's going to be much, much higher than that in the years to come. So it's just a great high-class problem to wonder, will it be 50 next year? Will it be 60, 70? But I think the gold-silver ratio, we're not seeing the kind of the ratios we saw in 1980 or what was it, 2011 at 15 and 32.
The current gold-silver ratio, hovering around 100 to 1, is unusually high, suggesting that silver is still significantly undervalued relative to gold. Analysts widely forecast a move to $40 to $50 or higher in the next 12 to 18 months, with further upside potential beyond. The current rally isn't merely speculative. Data from COMEX inventory reports shows physical demand outpacing available supplies, creating genuine scarcity pressures in both metals. Silver typically exhibits greater volatility and often outperforms during the later stages of precious metals bull markets. The current gold-to-silver ratio remains well above historical averages, suggesting the potential for silver to outperform over the longer term as this ratio normalizes. Matthew Piepenburg is a Zurich-based macro strategist and partner at Von Greyer's, known for his insights on gold, silver, and global financial risks. He points out that gold is a long-term hedge against the inevitable decline of fiat currencies, not a short-term get-rich play. Kiyosaki predicts silver could double to $70 by year-end, with the potential to triple in value by 2035. Unlike gold, silver's dual role as both an industrial metal and a store of value creates a double catalyst for growth. Gold, nearing $3,500 per ounce, is no longer just a hedge, it's a central bank darling. In 2024 alone, central banks bought a record 1,300 tons of gold, signaling a global shift toward hard assets. Kiyosaki envisions gold soaring to $30,000 by 2035, driven by currency debasement and systemic instability. While gold's rise is slower than silver's or Bitcoin's, its stability and centuries-old reputation as money make it indispensable for portfolios. Kiyosaki emphasizes owning physical gold, not ETFs, to avoid counterparty risk. Central banks have become significant players in the gold market, with a major shift in their positioning over the past decade. According to the record-high gold analysis, central banks purchased 1,136 tons of gold in 2023 alone, continuing a multi-year trend of substantial net buying. This represents a dramatic reversal from previous decades when central banks were net sellers of gold. Major buyers include China, Russia, Turkey, and various emerging market nations seeking to diversify reserves away from dollar-denominated assets. This central bank demand creates a substantial floor for gold prices, signaling an increasing institutional concern about traditional reserve currencies. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
For a while, should I buy at these levels? I even have clients who've had for years. Should I buy at these levels? I see dollar cost averaging in, and I just wrote an article that I published today. Is it too late for gold? Have you missed your window? It's an absolutely fair question. And of course, you're going to say, well, Matt's an executive at Zurich. He's going to say, of course, it's not too late. Buy as much gold as you want. And that is my answer. But let me give some reasons why, so I'm not just pitching my book or selling my widget, because it's a fair, and you should be skeptical. But you should also look at the facts and then make your own opinions. First, as you said, gold's at nominal all-time highs this year, but in inflation adjusted, it isn't. We'd still have to go up many percentage points to reach the 1980 levels. And measured against the broad money supply, gold's about as cheap now as it was in the 70s. That's just a fact. You could argue on a technical basis that gold is still a good price in the 3,000, the 3,300, 3,400, 3,500. That seems hard to believe. I remember having this conversation with gold at 2,600. I've missed my window. I remember with 19, because it wasn't that long ago, gold was at 1,600. And I'm not saying that gold just goes straight up. it could have some severe pullbacks, and you could wait for those. Uh, and so the other answer to that question is, and you just answered for yourself, is what's your time horizon? Because if your time horizon is 10, 20 years, as opposed to the next fiscal quarter or year end, and that's why a lot of family offices are afraid because the CIOs or bankers or ex-bankers, their performance is measured, their salary is measured by their overall return. If gold pulls them down, they're thinking one quarter, one fiscal year. If you're actually being a fiduciary, you don't want all your boxes and allocations to be green. That means you're doing something wrong. But if you're thinking 10, 15, 20 years out, whether you bought gold at 3,300, 2,900, or even 1,800 is going to be immaterial. My target, like Ronnie Sturflis for the next couple of years, is 4,800. But I think it's going, and again, I'm not saying this to just throw it out there. We're going to revalue gold. It's going to be part of the new reset whenever and however that involves. It's certainly replacing the 10-year. We're looking at gold at 10,000 conservatively, not next week, not even next year. Could be, but I have no idea how to predict that. But if I'm looking 10, 20 years out, it's going to be much, much higher than it is today. And whether you bought it 33 and change or 36 and change will be irrelevant in the long run if you're thinking that way. If you're trying to trade commodities or trade futures or trade precious metals, like any hard asset, you better have your stop losses in place. You better be looking at your Bollinger Bands, your Keltner Bands, and all that. If you're purely a speculator, that's a very different question. And I'm not the right person to ask. I've seen many commodity traders fail miserably at trying to time short or long hard assets. Again, but again, if gold does go to 4,800, then to 6,200, then to 10,000, again, that doesn't mean that you're doing the world is doing well. That doesn't mean that you're being richer, but that just means that the cost of a car tire or a house or a new mattress is going to be significantly higher. You can also certainly get price appreciation, but as Egon I say so many times, it'll be a sad day when gold's at 10,000, but thank God I'm in it. And again, I use Egon as an example. He had made a lot of money as the chairman of a FTSE 100 company. He could have done anything he wanted with. He could have invested in any asset class. He bought gold at 300, not because he was trying to get rich when gold went to 3,500. This was 20 years ago or 25 years ago. He was just thinking, whatever money I made, whatever money I'm going to earn, it's going to be in a paper asset. It's going to be in a fiat currency, whether it's a Swiss franc or a euro at the time, or at that time, even before, a Deutschmark or whatever. He wasn't thinking, how can I get rich on the money I have and get richer? He was thinking, how do I preserve my wealth? And that sounds very boring. So he just bought gold at 300, a lot of gold at 300. Now, of course, when gold goes from 300 to 3,500, he's extremely happy with the price appreciation. He actually got richer. But more importantly, he didn't get poorer. And that's kind of the model we look at. Yes, he got much richer by investing in gold, but that was never his motive. But you will get richer with gold over the next 20 years, even at these price points, is my short answer. I guess I say think like Egon. And he's been an immense mentor to me because I'm thinking 20 years out and I'm thinking of my grandkids and my retirement, so to speak, or whatever. I don't really need to be worried about polo ponies when I'm 75 or a new car. I don't really have the desire to get richer, but I could get richer on gold. But more importantly, I know I won't get poorer. And I'm saying that, again, Egon was all about wealth preservation, but yes, he also benefited from massive price appreciation and massive returns. And I think you can get both. And it's a long way of saying if your window is reasonable, respectable, and if you have conviction, because not once did Egon sell his gold when it was ripping into the 80s and then going down in these highs and lows, just stuck to gold because he had the conviction that eventually paper money would do what it always does and go back to its intrinsic value, which is effectively zero. Now, I'll repeat, when measured against a milligram of gold, the US dollar has lost 99.1% of its purchasing power since 1971 when we went off the gold standard. That's a simplistic but very important percentage. You can look at it in different ways. But what Egon understood and what our clients understood, and a lot of your viewers understand, it's not that gold is rising over the next 10 years or the last 5 years because gold has gotten more important in terms of its use or in terms of its shine. It's rising because debt markets and hence currency markets have gotten so pathetically embarrassing and so unsustainable and so discredited that gold is doing what it's been doing for thousands of years, getting the last laugh on failed policies from modern monetary theory and the fantasy you can solve a debt crisis with more debt and monetize that debt with mouse click money. If you're 10, 20 years out, I wouldn't worry, Jesse, whether you buy at 33, 36, or 31. And I'm not telling you where the price is going to be next week because I don't know. No one does. I just know secularly it's going to go north because paper money has consistently gone south, regardless of the relative strengths of currency. I'd much rather have a dollar, a Swiss franc, than a peso. I would. But again, all of us need to protect against the obvious now decline in fiat money. And that's been our message for decades. It's still our message now, but I think Egon's example is telling. It's not a lucky break. It was a thought out conviction that will be just as true for people who buy today for the next 20 years as it was for him 20 years ago. I really believe that.
Matthew Piepenburg highlights that today's financial markets are being artificially propped up by central banks prioritizing the survival of debt and bond markets over currency stability. To keep bond yields low and debt servicing costs manageable, central banks are injecting liquidity, which fuels asset bubbles in equities and ETFs. This temporary prosperity, based on cheap money and investor complacency, masks deep systemic fragility. Retail investors and high-frequency traders chase returns in markets that are disconnected from fundamentals, believing the Fed will always bail them out. But eventually, bond yields will rise uncontrollably, central banks will lose credibility, and the illusion will collapse. This isn't real capitalism or price discovery. It's a liquidity-driven charade that only benefits a shrinking few. Meanwhile, inflation silently erodes the real value of returns, and the dollar itself loses purchasing power each year. Another 2008-style rescue is unlikely because this time the debt and currency damage is far worse. Those chasing market tops could face devastating losses, mainly if they depend on retirement savings. That's why some seasoned investors are shifting to gold, not for quick profit, but to avoid financial ruin in a system increasingly rigged and unsustainable. Now let's shift our attention toward the interview.
The Fed, like every central bank, has to choose between a bond market, debt market, and a currency. And because debt is the rot wind beneath the wings of every economy, really today, except for maybe ironically Russia, debt and issuing credit and issuing sovereign bonds and IOUs is essential, to stay alive. You have to keep the yields on those bonds down. You have to keep the interest rates down. So you have to create artificial liquidity to save that bond market. Because if the yield on the 10-year treasury, and this is the stock mind, my stock mind, my past, I know that if the yield on the 10-year goes above 5%, that means the cost of debt too high. That means equities go down. So right now, to answer your question, I think Michael Burry is right. ETFs are temporary prosperity, which can lead to permanent ruin because they rise on rising tide of liquidity and low rates, and they tank if there's a needle that pops that. And then all things go down. So between the ETF demand, dovish Fed with a lower rate policy than it has 2 or 3 years ago, those tailwinds are massive. And then again, the constant moral hazards, a whole generation of young traders coming in who've never really seen a bear market, who weren't there 2000 or 2001 with the NASDAQ, or certainly weren't there at the GFC even. They've been conditioned to believe that we can have deficits without tears and that a Fed will always be there to protect these markets. And that, as I said, every crisis is a dip, every dip is an opportunity. The high frequency trading, algo AI, mega computing trading is also touted as this new savior, that we can avoid risk through these algorithms. And the high frequency traders are a massive percentage of the daily trading going on in the market. That was true even when I was trading. And I know Dallas to New York to Singapore who trade that way. They're not all brilliant. There is no easy answer. Just like AI is an easy answer. There's no doubt that a constant kind of electronic algorithm of demand going. And the signals that they would typically look at sell in a radical way are the same as the signals they would look at buy in a radical way. And without getting, and I'm not a high frequency trader, but I certainly know that those programs based on the cost of debt and interest rates and spreads between junk and between sovereigns, and those spreads are tight right now. Amazingly, high yield or junk bonds, they call them high yield. That's another euphemism out of Wall Street. High yield is just junk. There's not much high yield in high yield bonds. And again, when you look at the market, say, well, Piepenburg's precious metals guy, he's a perma bear. I'm not. I've been risk on many times. I was risk on when we had unlimited QE in 2020. I was risk on in 2024. Powell was announced potential rate cuts. We knew they were coming. They didn't come till September, but just the announce. So I'm not a perma bear, but I know realistically these are not sustainable markets. And again, as a precious metals guy, I'm less interested in speculation these days. People I know are traded with or invested with, whether it was Ray Dalio Dalio. I certainly rest with Jeremy Grantham. I loved his fund. He was a great manager. Paul Tudor Jones, even Pimco, Kim Mueller. They are just, if not more bearish than I am, and they are following risk assets. But this brings us to the world of McKay and Graham and Farrell. Kay was talking about the madness of crowds. This is the madness of crowds. These chasing these tops. This belief that the Fed will save you. This fear of missing out. Get more alpha out of a very Fed-supported market. That is and it is euphoric during that temporary prosperity, but it is a very brutal karmic gut when things go wrong, and we can talk about those could be. And again, Bob Farrell, guy who said the most important and overlooked power in the markets is mean reversion. That rubber band that goes up, down, it goes down, comes back up. Mean reversion would put the markets at 50 to 75% less than they are right now. That's a normal market cycle. Again, interrupted by the absolutely unnatural force of a central bank monetizing the bond market and therefore effectively, indirectly monetizing the equity market. And then there's, Graham, the famous value investor. There's not a lot of good balance sheets on these markets. That's why Buffett, hundreds of billions in cash, despite frothy tops. Now, what you just mentioned, Heinrich Sieberg, he's just as bearish as me, but he called for higher highs before this thing tanks, and he's been correct. So again, you can be temporarily bullish, or you can be risk on in a very risky topping market. That's up to your personality if you're a speculator. Sophisticated speculators, I think, more protected than just passive ETF investors who are listening to their financial advisors or RIA industrial complex, pure consensus thing. Because in a bull market, everyone looks brilliant. In a Fed-supported market, everyone looks brilliant. And when something goes wrong, they'll blame that on exogenous event, black swans, and they'll take no responsibility. And I think there's a large class of people who can't afford another 40, 50% dip, especially if you're older. And there's a society that relies on a 401k. There's a middle class that relies on a 401k that cannot afford that, because if we have another major dip, the only way to save that be to head to the moon to effectively monetize the equity markets. You could even have direct investments in equities. Yellen talked about that years ago. Or you could just do super QE, and that would create another headline bull, but that will be at the expense of the dollar you measure your portfolio in. And again, that dollar on a relative and on an absolute base is compounding losses year to year. If we're losing 10% this year and 6% the year before and 5 and 9 before that, in just the last 4 or 5 years, you're losing 25%. So your dollar buys 25 cents less. On a compounding level, that is extremely painful. Buffett talked about don't underestimate compounding returns. Don't ever estimate compounding losses through the invisible tax of inflation and the debasement of your currency. That absolutely fatal. And it ignores, even if the markets are up 7%, actual inflation is 9 or 10%, because we know the CPI is bogus. It's been adjusted 22 times since 1980. It's a fiction. We know without the BLS telling us $10 or $100 doesn't buy what it did 10 years ago. It just doesn't. So if you're making $10 or $100 more, you're still running uphill in roller skates. I think that's the big trap. If you're getting 20% this year, or you got 8%, or Jeremy Siegel's annualized 8%, you're losing all of that to inflation anyway. And again, that's just empirical. We don't have credibility anymore with our currency or our bond market, 4 trillion or 5 trillion. And so there's going to have to be some pretty tough scenarios. Bond market is everything. It is the stock market. And we could talk about those scenarios are going to be, but there just won't be this time around. And so this temporary prosperity, this good times, and again, I've chased tops in 2020. I've chased them in 2024, even though they were overvalued. But I'm much more like Buffett now. Enough is enough. I don't know if it ends in a week, a month, or 6 months, but I don't care. And frankly, I'd rather preserve the wealth that I have right now rather than chase some more. I recognize there are many who don't have that problem or that high class problem. And so what else can they do to prepare? And that's why I went from stocks and risk assets into precious metals, not because I thought it was a chance to get rich quick. It's outperformed the S&P for the last 20 years on a total return basis. So even on a purely speculation, gold has done better for me than the S&P if I bought a passive ETF. But I think at this particular time, and I've said that before, fall out of that ETF bag. The markets are driven by liquidity from a central bank, or the hope of liquidity from a central bank if anything goes wrong. And that is frankly not the stock market of Benjamin Graham or Warren Buffett in the 70s. It's just not. So, we're in it looks good right now because of a rising S&P, but that's lipstick on a pig, Jesse. That's what I see. It's just lipstick on a pig. It's hiding trillions of cracks.
Silver is drastically undervalued in comparison to gold, and analysts predict a significant upside in the future years as industrial demand and monetary instability rise. Central banks' unprecedented gold purchases reflect a growing global skepticism of fiat currencies and a trend toward tangible assets. Gold and silver as critical long-term protection rather than speculation against systemic collapse. As market distortions worsen and inflation slowly erodes wealth, tangible precious metals provide a timeless and increasingly important safety for anyone looking beyond the next quarter. How would the price trajectory of silver change over the next 5 years if the gold-to-silver ratio returns to historical averages? Do investors underestimate the influence of central banks on long-term floors in commodity prices? Feel free to share your feedback in the comments below. If you found this helpful video, hit the thumbs up and subscribe to keep up with our latest updates.